Why would a profitable company suddenly go bankrupt? That sounds backwards.
Because profit is an accounting idea, but cash is what pays bills. You can show profit on paper while your bank account hits zero. That's why we track working capital.
So what exactly is working capital? Give me the simple version.
It's your short-term assets minus your short-term liabilities. Think cash, inventory, and money customers owe you, minus what you owe suppliers and payroll. A positive number means you have a cushion.
Got it. So if a company has $5 million in assets and $3 million in liabilities, that's $2 million of cushion. But is bigger always better?
Not always. Too much working capital can mean cash is sitting idle. But too little is dangerous. The real question is the trend. Is the cushion shrinking quarter over quarter? That's your early warning sign.
What about the current ratio? I see that number everywhere. How do I read it?
Current ratio is current assets divided by current liabilities. A ratio above 1 means assets cover liabilities. Above 1.5 is generally healthy, but below 1 means you might struggle to pay near-term bills.
But isn't inventory part of current assets? What if a company can't sell its inventory quickly?
Exactly why we use the quick ratio. It strips out inventory, leaving only cash, marketable securities, and receivables. It's a stricter test. Can you pay bills without selling stock? A quick ratio under 1 is a red flag.
Can you give me a real example of where this mattered? A company that looked fine but wasn't?
Think of a retailer that overstocks before a holiday. Sales miss, inventory piles up, current ratio looks okay, but quick ratio drops. They can't convert inventory to cash fast enough, so they miss supplier payments and spiral.
So what's the cash ratio? Is that even stricter?
Yes. Cash ratio is just cash and cash equivalents divided by current liabilities. It ignores receivables too. It's the most conservative. Can you pay everything with cash on hand right now? Most healthy companies run below 0.5.
And what about the cash conversion cycle? I've heard that term, but it sounds complicated.
It's the days it takes to turn inventory into cash, minus days you get to pay suppliers. Shorter is better. A long cycle means your cash is trapped in operations, even if profit looks fine.
So if I'm a beginner investor, what's the one thing I should check first?
Look at the trend in working capital and the quick ratio over the last 4 quarters. If both are falling while sales stay flat, that's a warning. Don't wait for the income statement to tell you. Liquidity fails first.
That makes sense. So a profitable company can still be a ticking time bomb if its short-term cushion is eroding.
Exactly. Profit tells you the story of the past. Liquidity tells you if you'll survive tomorrow. Always check the balance sheet's current section before you trust the earnings number.